Assalamualaikum and hi, welcome to Company Taxation Interactive video. Now I'm going to explain on the introduction of the company taxation. Tax computation of a company is based on the audited accounts and the additional schedule provided by the company. Therefore, it is necessary for the company to keep the tax computation and the audited accounts for inspection by the IRB in the future. Prior to year of assessment 2001, both Form C and the audited accounts are required to be submitted for the assessment. However, after year of assessment 2001, the company is required to submit Form C only within 7 months after closing the year ends. Documents maintained by the company, which are computation of statutory income, current year business loss, withholding tax payment to non-residents, information on 5 directors and 5 main shareholders who are controlling the company. In order to compute the adjusted income, you need to identify the net profit before tax of the company. And then you need to add with the non-allowable expense and to be deducted with both expense in double deduction and the non-taxable items credited to income statement. What is non-allowable expense? Non-allowable expense are the expenses that need to be added back after the net profit before tax. The expense can be divided into 4 different groups, which is expense that are not incurred, capital expense, expense related to investment income, and the prohibited expense under Section 39. These are the examples for each group of the non-allowable expense. For example, depreciation, general provision, pre-commencement business expense. You can go more details on the page 457 and 458 on the textbook. Capital asset expense of the profit and loss account. These are the expenses that are not deductible, which means that you need to be added back after the non-allowable expense. These are the examples of the capital asset expense of, which is renovation of factory, improvement for repairs and small value capital items. What is allowable expense? Allowable expense need to be deducted after the non-allowable expense and the capital asset expense of, which is wholly and exclusively revenue expense incurred and the production of the income.
Double deduction refers to revenue expenses incurred that is given twice the amount as deduction in arriving at the adjusted income of a business. This is a tax incentive provided by the government to provide tax relief to business persons and to encourage the use of promoted activities such as research, local facilities, and others. To qualify for double deduction, firstly, such expenses must be revenue expenses, and second, the expenses must not be prohibited by Section 39 of the Income Tax Act. Now let us see a list of expenses that are qualified for double deduction. Firstly, we have the remuneration of handicapped employees, revenue expenses for promotion of export, and approved training by manufacturing or non-manufacturing company. As for capital expenditure, the government has given order to grant special deduction to relieve the business person. For example, 20% of the cost of acquisition of proprietary rights are given deduction in the year of purchase and for following years. Moving on, the cost of developing website as well as IT-related expenses are also given special deduction as mentioned above. More examples are available in the textbook.
Next is computation of statutory income. Then, this is the format on how to compute the statutory income. Begin with the adjusted income and add in any balancing charge and minus all the capital allowance, balancing allowance, and an unabsorbed capital allowance brought forward. It means that any capital allowance from the prior years which is not eligible to deduct because the company was suffered loss. So that's why we need to carry forward all the unabsorbed capital allowance. In addition, we can claim also for the allowance in that particular year of assessment. For the capital allowance, there are 5 categories, which is general capital allowance for plant and machinery, industrial building, agriculture, forest and mining allowance. However, if the business is involved with forestry, then we use the forest allowance. Moreover, sometimes the item need to be eligible for more than one allowance, but we can only claim one item for one time. So we need to know which one gives the highest rate. Next is how to compute the aggregate statutory income. If they have more than one business type, so we need to calculate for each business income and have the calculation of the statutory income for each business type and add up all of those so we can get the aggregate statutory income from business. Then after that would be other investment from section 4C, DRE, etc. such as dividend. In addition, we need to take note that current year business loss can reduce the aggregate income, which means all type of income that's not only for business. Then, if it's unabsorbed business loss, it can be reduced only on business type. For the capital allowance, it's restricted on its own business source only.
The next step for computing the total income or chargeable income is the computation of total aggregate income. In order for you to compute the total aggregate income, it is important to identify which amount that need to be included or deducted. So after you get the amount of total aggregate statutory income that only refers for the business only, the first thing you have to do is you need to deduct the unabsorbed business loss, reinvestment allowance, and investment tax allowance if any. And then you need to add the other investment income or non-business sources of income such as rental income, interest income, or dividend income, as well as the recoveries. And finally, you will get the amount of total aggregate income. The unabsorbed business loss need to be deducted in order to compute the total aggregate income. The unabsorbed business loss is a pool of losses which consists of the aggregate of all business losses from prior years. So any current year business loss that cannot be fully utilized against the aggregate income will be added on the unabsorbed business loss and carried forward to the next year assessment. Next, you have to add the investment income or non-business sources of income such as interest income, dividend income that falls under Section 4C of Income Tax Act and rental income under Section 4D Income Tax Act. So if any of the income have losses, they cannot carry forward the losses through the current years. You also need to add the recoveries which coming from the approved agriculture project or abortive prospecting expenditure if any. This is a situation where the prospector receive an amount from the sale of rights or a grant from government or state government. And finally, you will get the total of aggregate income which include all sources of income.
Then the last one is computation of chargeable income. So how to calculate the chargeable income? By starting from the total aggregate income, we need to deduct current year business loss, approved donation, group loss relief, and approved agriculture project to get the total chargeable income. Next, it is about the approved donation and what would be considered under the approved donation. Approved donation is the gift of money made to the government, and under Section 44 subsection 6 of ITA, the donation must be in cash and not in kind, except for the gift of artifact, painting or manuscript, which is based on valuation made by the Department of Museums or National Archive. Moreover, any excess of the approved donation cannot be carried forward, and the cash donation is limited to 10% of the company's aggregate income for that year. Next, one of the approved donation is donation to approved libraries. It can be deducted if the amount of cash contribution is not exceeding 20,000 ringgit Malaysia. For the business zakat, it shall be given tax deduction. The deduction will be lower of 2.5% of aggregate income. For the cash contribution to any sport activity approved by the Minister or the Commissioner of Sport under Sport Development Act 1997 is also allowed a deduction. And then, after calculated the total chargeable income, we need to refer this table to find out the tax rate involved. If the paid up capital less than 2.5 million, the income will be taxed at 18% for the first 500,000 in year assessment 2017 and 2018. and 24% for the subsequent balance. And for the other years, you guys can refer this table. For another one, if the company with paid up capital more than 2.5 million, it will be charged at flat rate, which can be referred on the third column. That's all from us. Thank you and good luck everyone.